Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here in the office today. A lot of stuff to talk about. We got a lot of data coming out from every news outlet and radio station. People here in America, are looking at this stuff either online or through some, media outlet, Fox News, CNN, whatever you are a fan of. They do a great job of highlighting all the problems of the day, of the week, of the quarter, of the year. But what they do a terrible job of is giving you historical precedents. It's almost never the first time we've been through whatever it is that headline news is talking about. What we take pride in here at Shepherd Wealth Management and on this show, the Financial Shepherd Podcast, is actually providing you all with historical data saying, hey, this is what happened under very similar circumstances. And this was the end result 6, 9, 12 months later from a performance standpoint. And that's how we can begin to game plan how we're going to build our asset allocation. That's also how we control our temperament. And there's really two key drivers that control performance. First and foremost, Warren Buffett, best investor of all time, as we know, and is not disputable, said the number one thing that he would hire for is temperament, somebody with a great temperament as opposed to a bunch of degrees next to their name. How we control temperament is getting an understanding of what history has to say under similar circumstances and why history is important. Buffett also famously said the one thing we know for sure about human beings is they don't learn from history. And last time I checked, the market's made up of a bunch of human beings. So that's the point of this show. We're here to have fun, provide some advice, some education. We're getting into some very topical conversations But before we even do that, we just got off of July 4th. It was the beginning of Q3. Already officially halfway through the year. So we got July, August, September, and then before you know it, we'll be at Q4. Literally shopping for Christmas presents.
Man, you just can't hold them cues back.
It's what I do. I live quarter to quarter.
Yeah. We just made a huge leap in the next, brand of T-shirts for SMW T-shirts. Living quarter to quarter, baby.
Living quarter to quarter. And the great news is, I'm just going to take a collective breath here.
Yeah.
And I think what I smell is winning. Everybody coming into this year said the exact opposite of what I've been saying. And for those in that camp of what I have been saying, we've been right. We're going to talk about why that is. It's not that I'm the smartest guy in the room. I'm from Cincinnati, Ohio. Therefore, I am by default never the smartest guy in the room. And that's no knock on anybody in Cincinnati. We got some smart cats out here, amazing universities, all that stuff. But coming where I came from in Cincinnati, specifically in Hamilton, Ohio, not a knock on anybody there. Awesome baseball, a lot of good memories there. But definitely not the smartest guy in the room. It has everything to do with the fact that we understand human beings and history. And of course, going to grad school in finance and getting CFPs and, decade plus in this industry, obviously I have real world experience and the technical experience to apply the academic information to historical information. And that's how we're able to build a pretty strong case as to why we do what we do for our customers. So I'm excited to get into that today as well.
Yeah.
But again, July 4th, man, you reside in Louisville, Kentucky.
I do.
We got a lot of clients out that way. You got to say Louisville correctly.
Got to.
And I know that you all have the pretty cool fireworks show, Thunder Over Louisville. And in my house, we heard it all because obviously in Kentucky, people shoot off fireworks. We heard them all, saw them all from my deck. But pretty much everybody in my house was sick during that time. So I spent a lot of time at CVS. So hopefully you had a better 4th than I did.
I did, yeah. I mean, I kind of chilled out. We do our big, like you just mentioned, Thunder Over Louisville is the big fireworks show down there. That actually happens around the Derby time. So,
okay.
About, early
that was in May.
Late April, early May. Because they just can't wait to blow stuff up in the sky. But I kind of chilled out due to it being a weekend. Well, I guess 4th of July was a Tuesday, but people treated it like it was a long weekend. So starting about the previous Thursday, every night, there was a lot happening in the neighborhood. And I don't know about you, but it was hard for me to determine what was a celebratory gunshot versus what was an actual firework.
Well, I'm sure they had their hands full out there in the Louisville Metropolitan Police Station that particular evening. But it seems like everybody was okay. Didn't.
Yeah. I mean, it wasn't at anybody, just yeehaw, let's fire this into the ground kind of thing.
Let's hope it was just in the ground.
Yeah.
Not straight up in the air, but
Right.
a lot of fun stuff, obviously, for the remainder of the year. From a calendar standpoint, this is summertime. Everybody's out and about. This is also quarterly review time for me. And I'm probably the most popular person on people's vacation just because they're actually taking the phone call while they're on vacation, and obviously excited to hear about, the great success that they've had so far this year, which is, again, the exact opposite of what everybody else had to say coming into this year. And that's where I wanted to start. Is there are still a ton of bearish investors out there with a bearish mindset, and a ton of hawkish talk from the Fed heads, as I call them. Not just Jerome Powell. And we're going to talk about that as well. So I'm going to give you all 3 reasons right now. We're going to kick off the show, just going right for it as we're coming out swinging. I'm coming out of my corner.
Do it.
We did the pleasantries. We tapped gloves here, and now it's time to come out swinging a little bit.
I mean, if the bell's rung, it's game time.
Let's go. So we got 3 reasons why this bearish case that people on CNBC want to keep making, and all this hawkish talk from these Fed heads is just getting dumber and dumber.
Okay.
Which also a great movie.
Oh, yeah. Big gulps, huh?
See you later.
See you later.
Yeah. So I'm going to give you these 3 reasons. All right. So first, CPI. We just got CPI the other day, literally yesterday. And that is the headline inflation number. But core CPI, which is what the Fed wants to spend their time focusing on, that came in at a positive 0.16%. Month over month. And that was a huge surprise to the downside. Not a surprise for me. If you go back and listen to our last podcast, which you can go to shepherdwm.com, there's a link right there on our website, takes you right to YouTube or Spotify. If you're walking around the neighborhood and want to listen to this, we kind of called this, and it's not because, again, I'm the smartest guy in the room. It's just the way that they calculate CPI. It's a backward-looking measure of inflation. They give an equal weighting to all month over month for the prior 12 months. And we dropped last June 2022's month over month CPI print, which was 1.2%, which was the highest month over month CPI print we saw all of 2022. So that number got dropped because we're now in July.
Yeah.
So just simple math was going to tell you that was going to change. And we broke down why there was positive inflation in the last CPI report that we got in June. So we broke down all of those things. So we kind of called a lot of this.
Yeah.
Excuse me. And I got to give a lot of credit too. We do a ton of research. Again, we subscribe to a lot of stuff, Barron's and a bunch of others, but a huge shout out to Fundstrat, Tom Lee and his team. They've been getting a lot of hate really since, I don't know, September, October of last year. And again, we've been in a lot of the same camps as them. I truly love the way that they use historical statistics and data to explain why they feel the way that they feel. So again, I really love their stuff and support it quite a bit. And he's been getting a ton of hate, but he's been 100% right. He's one of the only people that was calling for the S&P 500 to really have any substantial gains. Definitely the only person calling for double-digit returns. At least all the people that I follow on, CNBC and other news outlets, and everybody thought he was nuts.
Yeah.
He's the only person that's been right in all that camp. So, and again, I track it, I follow it, and some of the data that we're going to be talking about today is certainly from Fundstrat. So huge shout out to those guys. But getting back to this. So the first thing, CPI came in at 0.16% month over month. Consensus market was expecting 0.30. So literally, half of what people were expecting from inflation month over month, came in, half as much as what they thought it would. So that's awesome. Now, this June CPI print, breaking it down into the bearish views. So there's kind of 3 anchored views for the people that are still like, hey, the market's going to fall to 3,200 or some nonsense like that. They're going to say there's sticky inflation. I think that inflation's broken to the downside. We'll talk more about that here in a little bit. This would undermine this quote unquote higher for longer, stance that these Fed heads keep pounding the table on. So seriously, why would a 5.5% Fed funds rate, which is close to where we're at right now, they'll likely raise rates here July 27th when Fed chairman comes out 2 o'clock on the 27th to say what they're going to do with rates, either raise them or pause. The market's given them like a 90% probability of increasing rates by 0.25%.
Right.
And because of that reason, because he would be shocking the market if he didn't raise 25 basis points. I think he would actually shock it to the upside, but a lot of people would say, oh, he's not raising rates again, so there must be some problem with regional banks or in the financial sector. And that's a reason for the market to sell off. I think that's garbage. I don't actually believe that at all. If you were to pause and actually back that up with all the data points that I'm about to drop on you all today, I think it'd be fine and the market would be fine. But because he's given this cover, 90% approximate probability of increasing rates in July, he'll probably do it. But if you ask yourself this question, why would a 5.5% Fed funds rate be necessary if the core number, that CPI number I just gave you, if you annualize that, that's tracking sub 3% roughly, right? You're going for 2% as your long-term target here. Now, I get that this is one CPI print, but you've gotten 11 straight prints of declining inflation, and I'm about to drop even more data on everybody here in just a second to back that rationale up even more. Therefore, I don't believe that there's going to be any hard landing at all. The Fed does not have to break the economy. They're talking tough to salvage some credibility, which is the dumbest reason to make any decisions at all, let alone decisions that affect everybody across, all societies, given the fact that the U.S. dollar is the global currency, and the Fed is in charge of price stability, which is inflation, and maximum employment, which they already have that box checked. So it's kind of a big deal to ask them. They need to ask themselves these questions. And I certainly hope when Fed Chair Jerome Powell talks to everybody on the 27th, when he receives his questions from the audience there, hopefully they start to ask some of these more difficult and challenging questions, like why cause a recession when we don't need one. Second, this is repeatable. So I get that this is one print in July that came in way lower than consensus expectations, but I do believe that this is repeatable. For example, we saw used car prices. It's this month-over-month measure. They call it the Mayhem Index. It showed a negative print for the first time, but it was only negative 0.5%, so hardly negative. The Mayhem report shows consecutive months of -3 to -4%. So this is that lag effect on used car prices that hasn't fully shown up in CPI data yet. It showed up as a negative, 0.5%, but the leading indicator, which is a Mayhem index for used cars, is actually showing months of -3 to -4%. So the next inflation report that we get after the summer, it should continue to fall, pretty rapidly from a used car standpoint. Additionally, shelter, which is the biggest component of the CPI calculation, shelter was showing a positive 0.4%. But if we actually use real life data, look at the Case-Shiller index and those types of things, people like Jeremy Siegel, who that guy is kind of the smartest guy in the room. He's a 50-year Wharton School professor, University of Pennsylvania. So people kind of listen to that guy when he speaks, but he's using real life data. And when he puts real life data in, shelter inflation is non-existent. It's either flat or negative. And that is not showing up in the CPI calculation yet. As I just mentioned, it's showing still positive 0.4% month over month. And literally that is 70% of the inflation number that we got yesterday. 70% of the inflation that was actually showing positive came from shelter. And that has the longest lag effect. Everybody knows that. Right, that's not any news. That's not surprise. It's not going to be breaking news on CNBC today. And the Fed as much acknowledges that. But if that's 70% of the reason why we even have any positive inflation, and we can see leading indicators showing that there really is no inflation in shelter, and the used car inflation is about to fall off a cliff, that's a great reason to think that this is all very repeatable going forward. We think that the flows through CPI will finally take place sometime here, in August. And if we actually remove housing and cars from that core CPI metric, CPI is tanking. It's 0.026%, or if you annualize that, 0.3% inflation. Like that's no inflation at all. So literally inflation is falling like a rock. And I know that I'm not the only person with this data.
Right. Well, we talked in the last podcast about how you didn't think that the Fed's, I don't want to say bullishness on used car prices and insurance inflation was going to be a huge driver. You know, we kind of address, seems like that data has been going around for, I mean, obviously it's data, so it comes all the time, but specifically the attention towards how this used car insurance lag effect is going to affect inflation. I mean, even the last episode, you talked about how you didn't think that was really a thing.
Yeah, for sure. And why these guys and gals at the Fed want to keep talking so tough on inflation is asinine to me. I mean, they're really trying to create some sort of credibility for themselves, which again is just stupid. I mean, I think if they were just very honest, they don't need to be flippant, but just very direct and honest, saying, hey, we got this wrong. We had to raise rates fast. We rose them very fast. We understand there's lag effects. 70% of the last inflation print was from shelter. We know that that's coming down. We see used car price coming down from an inflationary standpoint. You've already seen that in other goods and services. So we won't really feel the need to continue to put pressure on the economy and the financial sector by increasing rates. So we're just going to hold. As we said, we're going to be data dependent and higher for longer. But if we don't need to be, we don't know how long we're going to be this high on interest rates. That would be a very logical and reasonable response backed up by data, both on the backward looking and the forward looking data. So you truly are being data dependent in that sense. Last and third reason is that the internals, so how they calculate CPI, is collapsing. 45% of all the measures that they use to calculate inflation, what we know as CPI, is in outright deflation. If you look at the 50-year average of that data set, usually about 30% of those CPI metrics are in outright deflation. So we're seeing more metrics in outright deflation than even the long-term 50-year historical averages for calculating inflation. So for all three of these reasons, I don't see any reason why we need to increase rates in July, although likely will. Again, the market's giving him the go-ahead to do that. And the other thing I think people really need to consider and think about is I believe investors need to start considering rate cuts in 2024. So that higher, quote unquote, higher for longer is not so high for long, right? We're already 6 months into 2023, which means 2024 is right around the corner here.
Right.
And if we get rate cuts in 2024, I know it's a presidential election year, so a lot of, wonky things tend to happen just from an investor sentiment standpoint as we get closer and closer to that election date. But if we get rate cuts, I mean, that's going to continue to boost what's already been a great start to the market this year. And what I believe we got a lot more room to run in my latest newsletter, which we'll talk about here in a little bit more detail, that I sent out to clients beginning of last week, is that I'm calling for a new all-time high on the S&P before the end of the year.
Wow.
I'm calling for 4,900 on the S&P. The previous all-time high was 4,821. Obviously, we're tracking, pretty good to being able to achieve that, with the S&P sitting right at about 4,500 at the moment here as I'm sitting here talking to you all. So yeah, I'm definitely still very bullish for the remainder of the year, and you're going to get tech to continue to lead, but other sectors as well. So I'm excited to chat a little bit about that here, Ez. But those are the three big reasons. Again, I'm not the only person with the data. I know that the Fed can see all this stuff. It's just a question of what's more important to them in my mind. Is it their own personal view of their credibility, or is it the actual data that's slapping them right in the face saying, hey, there's no actual need to increase another 25 bips, because nobody's going to feel that. It's not going to filter through the economy for at least another 12 months to maybe 18 months.
And the expectation is that they'll probably erase that 25% points before it even actually shows up.
That's exactly right. Yeah, I mean, they'll likely give that back to us in early 2024, at least in my view. I think that's something definitely people need to consider here. And the reality is, everybody's still calling for this recession. They keep pushing out the date.
Yeah.
Everybody came into this year saying, hey, this is going to be, 2023 is going to be a recession. Like everybody thought that, except for a couple people. Tom Lee, myself, Jeremy Siegel, and a handful, of other professionals that you all would see on, CNBC or other news outlets. Everybody thought that this was going to be an awful, negative, double-digit kind of year. And right from the beginning, those of us that were looking at the historical information coming on the back of 2022, we kind of thought this would be a great opportunity to get double-digit types of returns, and that's exactly what's happened so far this year. I mean, how could you possibly call a recession when you get earnings like Delta just reported this morning?
Did
you see that? I don't know if you saw it or not, but I know that you fly a lot and you see a lot of people on planes.
Well, yeah, I mean, I think that's a little, you also got to take into account they're not buying as much things. They're spending their money on experiential, right? Like experiential. Well, when I was a professor, we called it experiential education. That just meant field trips, right? You go out somewhere and experience something.
That's right.
And I think that's, hangover from the pandemic. People just bought stuff to cope with being isolated, and now everybody realizes they don't need that much stuff, or they don't want it, they have enough of it, whatever it is, and they're spending money on travel even if they don't really have a lot of money to spend. They're just saving it for that.
They took all their stuff, sold on was it Facebook Marketplace probably?
Yeah, or just kept it, and they're like, hey, you know what, actually I just want to go somewhere.
Yeah. I mean, that's the stuff people remember and to actually talk about on family vacations, holidays, whatnot. And
I mean, when you're, plastered to the same pair of underwear for 8 days, stuck inside, for 9 months at a time, you're going to be like, screw it, buy that Xbox.
Absolutely.
But now that you don't have to do that, it's like, no, I need to go see the world before we get stuck inside again.
Yeah. Now I think that's going to be a lasting effect on the minds of everybody that was alive during the pandemic. Hey, I want to go see some stuff and do some stuff just in case something, either happens to my health and I can't go out and about.
Yeah.
Or, you never know, something like that could happen again in the future and you kind of get locked down again. So
that's true. I mean, I know personally, and again, just for everyone listening and watching, this is a personal observation, right? Like for me, I get a lot of education about inflation and everything like that from the podcast and from being around, Shepherd Wealth Management. I still feel a lot of things that I'm interested in spending money on a personal level. They haven't really come down in price. In fact, they might even still be kind of going up. Mm-hmm. And for me, I'm kind of combating this idea of just flat out corporate greed of driving prices. So it's like, well, do I want to still pay money for something that, okay, yeah, it may have benefited me in the past, but now it's not really worth the price for what I get out of it. So instead, I just started saving that money for experiences.
Yeah. Yeah. People kind of shift the priority, right? Everybody's, got their budget or cash flow or whatever. And you're right. I think their mindset is a little different on how they want to spend that money. And that's going right to certain sectors of the market here. I mean, how could anyone possibly call for a recession when an airline not only smoked their top and bottom line estimates for revenue and profits, but they raised it.
Yeah.
And they're going to pay off like $4 billion worth of debt while they're raising it. Yeah. So, it's an airline. They've went bankrupt a few times.
Oh yeah.
All of them.
Especially Delta.
And it is the premier airline, I think, in a lot of people's minds, whatever.
I think you're still seeing Delta kind of, like you said, it's like you think about a flagship airline in the U.S. Yeah. It's above United, above American. I'm
a Delta, Sky Miles member. I fly Deltas here in Cincinnati. They have a little hub. But whatever. The main point is they're crushing it. And when an airline is beating and raising on their earnings report, that should tell you that there's no recession coming anytime soon.
Yeah, I'm a Delta guy as well. They really worked with me in the pandemic. I had to cancel a bunch of stuff for work, like right when that thing was kicking off. Mm-hmm. American just stole my money. Delta gave me endless credits. They were like, use it forever, never expires. Just please come back. So. But yeah, you're right. When they're popping off now, how can you call that a recession? On top of the unemployment rates, the jobless claims we get.
Yeah. Thank you for the leading, tossed up a little softball there for me.
I got you.
Initial jobless claims that came out this morning at 8:30. We were expecting 250,000. It fell to 237,000. And as we already know from the last jobs report that we got, unemployment rate still at 3.6%, which is like a 50-year low. So I'm having a hard time understanding why people are still so bearish. Maybe they have some sort of crystal ball that I don't. But on top of that, we also got the producer price index, PPI. Also a favorite Fed measure, but in my mind, it's kind of a leading indicator. We were expecting, put on the bifocals here.
Oh, yeah.
We were expecting 0.2. It came in at half of that, 0.1. And for the same reasons I just kind of outlined here about CPI, I believe that this measure is going to continue to fall and is going to fall a lot faster than what a lot of people would expect it to. So we're just kicking off earnings season. We're going to get some more earnings tomorrow from some of the banks, from United Healthcare as well. But earnings season is really just getting started here. So I expect earnings to be very good, better than a lot of people expect. And as we get to the back half of the year, the comparisons, right? If you look at year over year performance, and all these companies are going to be announcing earnings from the back half of this year. Remember, they're comparing themselves year over year to 2022 numbers,
right?
Q3 and Q4. And that's a pretty low bar that they're going to have to step over. And if inflation's falling, and we kind of are seeing falling inflation from a wage standpoint, so not everybody's getting a raise anymore like they were in prior 12 to 18 months. And revenue is up because, again, to your point, as when you do have inflation, obviously they have to make up that cost somewhere or they're going to lose their profit margins, right? And that's definitely not good for shareholders. So they were able to increase prices. They got the people that they need. And in some industries, they were able to reduce some headcount. Those people found jobs immediately somewhere else. We still got unemployment at 3.6, which is awesome. They have to pass that along at some point, but when inflation falls, they generally don't bring down those prices back anywhere close to where they were, because there still is a cost that they have to offset. And in some industries, this thing that they call pricing power, airlines is a great example of that. They may not have to bring that price anywhere close to where it was, prior to, rampant inflation that we saw last June at 9.1%. So, you're right. But that's kind of how the economy works, though. I mean, bread used to cost a nickel, a long time ago, and it just got a little bit more expensive over time. People's wages went up, cost of shipping and all that stuff goes up over time. So it's just the reality of the world. The only thing that's constant is change, and prices change, and we'll continue to do so into the future here. But that's the big reason why we as investors, the best way to offset inflation historically is either in the market, stock market, or your home.
Yeah.
And those are the two real asset classes that you can go back to over a very, very long period of time and say, yeah, this is a great inflation hedge. I know a lot of people that are investing in gold and silver and so forth might have a different opinion about that. But the reality is, if you actually look at the performance numbers relative to inflation on something like gold, yeah, that was a great inflation hedge up until the point in time where gold was no longer the standard that backed the U.S. dollar. It was the full faith and credit of the United States. So.
Yeah, that was when, like 1910.
It was a little after that, I think. I don't know the exact date, but
after World War I.
Yeah, we can definitely Google
off the gold standard.
Yeah, I think we can Google it and find out. I don't know the exact date, but I think so.
Yeah, I mean, I hate to say it because I don't want to knock on anybody else's thing, but like to me, gold is just useless. Like if it's not in a computer or it's like, I don't buy jewelry and
stuff
like that.
End of the world, so. Right? It's for the doomsdayers, right? I mean, there are some people, clients that their parents were not born in America, but moved to America, and now they had kids and they're now my clients that are U.S. citizens. And these people coming from other countries, they literally couldn't bring anything. Like this guy, he's a doctor now, and absolutely phenomenal doctor for a very long period of time. But his parents were from a different country. Yeah. And when they moved over to the United States, he was telling me the story like, we can only bring stuff that we could throw on our back, essentially. They came here with almost nothing, but the only currency that they brought with them was diamonds and gold.
Yeah.
Because you can wear it, easy to travel with, all that sort of stuff. So if you're like at the end of the world kind of person, yeah, great. You might want to think about storing some gold and diamonds and silver. But the truth is, if it's the end of the world, that stuff only happens once. Like who are you going to trade that with?
Yeah, that's what I'm saying. It's going to be worthless. And I mean, I guess my point wasn't that people don't find value in gold and diamonds. It's just that it is slowly declining in how much it's actually worth. I can remember in 2008 when that was a big hedge against what was going on. People invested in a lot of precious metals.
Yeah. And now
short term, but now it's like maybe not.
Exactly. Yeah. So, we don't talk a lot about that, but I totally understand why somebody might want to have a small piece of their asset allocation to something like that. But yeah, I mean, those are the reasons why I believe that inflation is going to continue to fall a lot faster than others, and a big reason why we do not believe that there's going to be any sort of recession coming down the pike here. But where are we going to see, more performance for the rest of this year? So a lot of people are talking about still that this market rally has really only been driven by 7 stocks. The Teslas, Apple's, Microsoft, Google, Nvidia, and some others, Google. And the reality is that's just not the case anymore. There are a lot of stocks within the S&P 500 that are trading above their 50 and 200-day moving averages. Now, they are behind performance-wise those big 7 tech companies that I just rattled off there, but they are coming to the party in a big way. So we're finally actually seeing, something like small caps, the Russell 2000, a lot of small regional banks inside that index. Those are rallying. Industrials, we talked about industrials being a great place to be this year. Outside of tech being the favorite sector, industrials are really kicking performance. Awesome performance so far. I can't wait to see their earnings. And in addition to that, energy is finally starting to get some legs behind it. And we don't even have a full China recovery from a energy consumption standpoint. So we got a lot of things to be excited about here in the back half of the year. But the key driver of our thesis coming into this year and still today is that inflation is actually falling a lot faster than what people think. So this notion of higher for longer by the Fed is just the Fed's way of controlling some credibility to getting down out of that 2% target on inflation that they're striving for. But the reality is, with the numbers we just got here today, that's already annualized tracking to about 3% and getting close to sub 3%. I think by the next time we get a CPI print, annualize that number, you'll be under 3 and very close to 2.5. So I'm looking forward to it. I cannot wait to see what happens on the 27th, even though I don't think they should raise rates. They probably will because they're getting the go-ahead to do so, and they think that they got some credibility problem. Okay, go ahead and do it. But earnings are going to be awesome, and I think this rally has a lot of legs to it. If I'm right and we get anywhere close to that 4,900 level, we're talking about another roughly 12 to maybe 15% in the markets, for the back half of this year. And we're already up about 17.5% on the S&P 500 year to date.
Well, good, because we went down quite a bit last year.
Yeah, I know we talked about that in a couple podcast episodes ago, where we kind of, reminded everyone of where we started.
Yeah.
And how we got here and why we had, the perception that we did in the market, why it was so different. And again, it's just so simple. It goes back to looking at history. Warren Buffett was asked in his most recent shareholder gathering in Omaha, is why won't investors just follow your playbook? You've been so open and honest about how you do things, how you view things, and you've outperformed the market. You get 20% performance since you took over the company. The market's averaged 10, like you literally doubled the market performance. Like, why don't most people just follow your recipe, so to speak? Because it's there, you can follow it. Simple answer. He's like, because people do not want to get rich slow. He made the majority of his money past the age of 60. Now, don't get me wrong, he had a lot of money, in his 30s, 40s, and 50s relative to the average American citizen. No question about that. But he made the bulk of his fortune past the age of 60. So it was more of a grind than what a lot of people actually realize. They just see him now, as one of the biggest companies on the planet, one of the richest people on the planet, and say, wow, that's awesome, did a great job, must be nice. But they missed all the times that he failed, all the struggles along the way, and actually how long it took him to build what he's actually been able to build. And he did it by understanding human beings. Obviously, he had a really good understanding of businesses, how to evaluate them. So the technical skills that you learn from school and from just natural experiences. But I think the biggest reason that he had the success that he had is he understood humans, and he was able to look back at what history had to say and apply that to what was going on now, and have enough of vision to say, okay, history is going to change. Technology is getting better, faster. Now I can change my views a little bit on how I build a portfolio. So I think that that's the secret sauce. That's definitely our secret sauce for success for customers.
Yeah.
Is controlling our temperament, our emotions, by understanding what history has to say, and then using that information to build an asset allocation around the customer, as well as what's actually happening right now. And we do all of this not just customizing things to customize them, but to actually achieve a result. That way, when we sit down every quarter, we can say, hey, the goal was X. We're either on pace, ahead of pace, or behind pace to achieve X. And here's why we are where we are. And here's what we think is going to happen over the next 6, 9, 12 months because of this historical precedent that is set, however long ago and however many times it's happened over the last 50 years or 100 years. So that's how we do it. That's the secret sauce. I don't think the playbook changes at all. I just think you're going to see a whole lot more participants in this market rally, being small caps, probably doing just as good or maybe even better than technology for the back half of this year. I think industrials are going to do amazing, and energy will participate in this rally as well. Coming out of the summer months, you just heard it from Delta. Their gas prices came down 32% from last year, but they're still filling up their airplanes, and people are still traveling all over the country via vehicles and so forth. So that energy trade's coming as well.
Yeah. I mean, I can't wait for things to come down. That's all I'm saying.
Yeah, I can't wait to talk about something else besides the Fed.
I know. I just have this sick feeling that despite the fact that data is going to show them the course of action, that they're going to get so hung up on that 2% number, and they're just going to keep squeezing everything until they get there. 2.1, 2.4 won't be good enough.
The one thing about it is this thing called self-preservation. I come back to just kind of, understanding human beings and how they make decisions. I think self-preservation is a huge motivator.
Yeah.
Because they do have two mandates. The price stability thing is inflation. That's why they're increasing rates or have increased rates. And the other is maximum employment. I'd say the primary reason why they were created was financial stability, right? And that is the reason why they were created. But employment, I mean, I don't know why anybody would want to root for people to be laid off in any way, shape, or form. I mean, that's the backbone of the economy. 70% of the economy is consumption from consumers. And as long as they have a job, the economy is going to be great. And the reason why I go to this self-preservation topic as it relates to your question is if they have to come on, CNBC on the news or get pulled into Congress for some sort of hearing like they do every month or two, these congressional leaders, they're going to look at them and say, hey, man, these people that voted for us to be in these seats here today, they'd like to keep their jobs. So why are you jacking around with interest rates when you can clearly see inflation's falling and falling very, very fast? Like, why do we need to have people unemployed? You're just fighting to have more people unemployed?
Yeah.
Makes no freaking sense. And actually, somebody in Barron's, I'm not going to drop their name. You can go to Barron's yourself and check it out. But this guy is calling for, he thinks that unemployment needs to get to 5 or 6% to actually break the back of inflation. I mean, seriously, this is the reason why I would love to be on CNBC. I wish we could have a bigger network to broadcast on.
Yeah.
Where more eyeballs were watching this, because they put more bearish people on TV than they do people in the bullish camp, if you will, because it grabs the headlines. It's what keeps eyeballs on the screen. It keeps people nervous. And it's keeping too many people on the sidelines. There's $5.5 trillion still sitting in cash that missed all of this 17.5% rally. They missed a 32% rally in tech. And I'm telling you right now, and I've given you actual data points that would lead me to believe that we got more room to run. Now, clearly, past performance is no guarantee of future results, and investing in markets always involves some risk, including risk of loss for all the compliance people that are out there listening to this. Of course, that is true. But if you look at what history had to say, you could have easily been in the same position that we put our clients in and absolutely knocked it out of the park from a performance standpoint relative to what the market's already provided. And all those $5.5 trillion that's still sitting in cash, once they start fighting themselves to jump into the market, that's when I'm going to have a completely different tune as to my bullish thesis. I'll let that wave run for a little bit because that's a lot of cash that still needs to get deployed. I mean, that's more cash than there was in the sidelines in 2008 and 2009. And this sure as hell isn't 2008 or 2009.
Nowhere near it.
Not even close to it. So you still get all these people that get put on Barron's and CNBC again, and they're just sitting here talking about the economy needing to go, into a 6% unemployment rate. I just don't understand it. It makes no sense to me. It's not going to happen.
No, it seems like an archaic solution to a contemporary problem. Like maybe that's how you quelled recession decades ago, as you jacked up, made people lose their jobs. But I don't know why we have to hope for that or even work towards that now?
Well, I'm looking forward to it. And I think there's a lot of things to be excited about. I think these folks in the bearish camp are going to have a hard conversation with themselves here pretty soon and going to have to make a decision very quickly, I believe. So I appreciate everybody listening to the show. This is awesome. Don't forget, we do this about every 2 weeks, as long as we're not traveling or there's some sort of market holiday or whatever. We try to put it on YouTube Live every 2 weeks. You can check that out. You can go to our website, shepherdwm.com, all the archive shows, links to all that stuff. I'm actually posting my newsletter that I send out to clients every month there. So those that aren't a client can check it out. And I'm sharing the data that we have. And we're also doing a Friday blog on most Fridays that I possibly can to kind of summarize what happened that week and why and what we can look forward to next. So anything else that we need to share with the viewers before we
just want to remind them that, we do this show to share Joshua's knowledge about the market as well as, his experience as a CFP. So if you have any finance questions or anything that's topical relating to the behavior of the markets, hop into the chat during our live streams or ask questions on the YouTube archive.
That's right. Yeah, we're looking forward to all those questions. Love to answer them for you. Again, you can always call and text those questions into me directly, 513-630-2664. This has been an absolute blast. I enjoyed it. We'll do this again in a couple weeks. We'll have the Fed information, I think, by the time we get back on here. So we'll have a lot to talk about then as well. So until then, hope you all have a great rest of your day.